Good afternoon, everybody. My name is Mike Paley, and I'm the Senior Marketing Specialist for NTCIC. We will be getting started in just a couple minutes. If you have any questions during the event or would like us to discuss anything further, please feel free to utilize the chat or questions aspects of the GoToWebinar. We will either cover those questions at the end of the event or during depending on the topic. So thank you again for all joining us.
To wait.
Well, hello everyone. We'll be beginning now. I appreciate you joining us for today's webinar on how to use tax credits in your Main Street. This is your host, Laura Burns, and I'm the Community Impact Compliance Manager for the National Trust Community Investment Corporation. And I just want to do a quick reminder that this is the second webinar in a three-part series. In our first webinar, we went over some tax credits in general, and in an overview of both the historic tax credit and the new markets tax credit framework. Since we did cover a lot of ground in that first webinar, we thought a question and answer format would be the best way to take a deeper dive into both the historic and new markets tax credit. And like any real estate transaction, we wanted to make sure we assembled the right team to help tackle these tax credit transaction questions. So today, we are joined by Dan Kolodner and Rita Schwantes from the law firm of Klein & Hornig, and Amanda Reed from the Novogradac accounting firm. Dan focuses his practice on community development projects utilizing tax credit financing. He specializes in complex deal structuring, combining tax incentives such as the new markets tax credit, historic tax credit, low-income housing tax credits, and renewable energy, with state tax credits and other financing sources in a variety of community development transactions. Rita has focused her practice on real estate, affordable housing development, new markets tax credits, and historic tax credits. She has represented developers, nonprofits, for-profits, health centers, charter schools, lenders, boys and girls clubs, co-housing groups, and cooperatives in a variety of transactions that also include bond financing, sales, acquisitions, new construction, rehabilitation, and mixed finance development. Amanda is a partner in the Cleveland office of Novogradac. Ms. Reed's experience includes working with complex financing for community development real estate projects, including the use of new markets tax credits, historic tax credits, public-private partnerships, and other state, federal, and local tax credits and incentives. In addition to her new market tax credit practice, Ms. Reed also focuses on low-income housing tax credit, provides accounting, auditing, forecasting, and compliance of developments subject to the regulatory compliance of the low-income housing tax credit and HUD. So first of all, I want to thank our team for participating in today's webinar. And as you have heard from their bios, this is really, truly a dream team. So thank you all for joining. As I noted, we have compiled some questions from our last webinar. And if you have not seen or heard our webinar, it can be downloaded at ntcic.com. And please be sure to submit any questions you have throughout the webinar, and we can address them as we talk about the topic or at the end of the webinar. And since this is our second webinar, I want to provide a brief recap and overview of what we covered during the first. And I want Dan and Rita and Amanda to please feel free to jump in and add anything to the recap topics I'll be going through. In our last webinar, we started off by introducing NTCIC as a tax credit syndicator, meaning that NTCIC connects private investor capital with developers rehabilitating historic buildings. We are also a qualified community development entity, which means that we can apply for and be awarded the New Markets tax credits. We went over some tax credit basics, and we highlighted several of the federal tax credits, and we also pointed out that 35 states have a state historic tax credit. We went over how tax credits reduce the amount of income tax dollar for dollar, which makes them so valuable. And we explained that developers of historic rehabs may not have enough tax liability to use the historic tax credit on their own, and that's where tax credit syndicators can help find more equity for the project by finding a tax credit investor. We also covered the NPS three-part process. The part one being that a building must be listed on the National Register or located in a registered historic district and is certified as being historically significant to that district. We also talked briefly about the part two, which is the description of the rehabilitation work that will be taking place at the project. And then part three is certifying that the work that was approved and described in part two was completed and that the tax credits have been earned. We also went over qualified rehabilitation expenditures, or QREs. We reviewed what counts and what doesn't count. And I really loved Meryl Hoopengardner's visual description for what counts as a QRE. She described sort of if you could pick up a building, turn it upside down, and shake everything out, everything that comes out wouldn't qualify as a QRE. Everything that's stuck to the building would qualify. Now, I think Amanda is probably making a face at this point, but that's why you need a good accountant on your team, is to determine what are QREs for your HTC projects. We discussed why the HTC is a 20% credit, and that's because the credits are based on 20% of the QREs. And we also went over how to calculate the value of the historic tax credit by using the 20% QREs and then the value that an investor is willing to pay for those tax credits. Continued on and talked about the New Markets tax credits and how it encourages investments in low-income communities that traditionally have had poor access to capital. We discussed the definition of low-income community and how it was based on census tract data, and that New Market tax credit eligible census tracts have a poverty rate of greater or equal to 20% of the area median income, a poverty rate greater or equal to 20%, or an area median income that is less than or equal to 80%. We gave you a great mapping tool that's located at the cdfifund.org, but again, I want to note that Novogradac also has some great mapping tools located on their website. We went over the New Market tax credit process and how that works. So CDEs like NTCIC submit an application telling the CDFI fund, who administers the program, what kind of activities we want to do. We then, if we're awarded tax credit allocation, review projects based on those activities. And for instance, NTCIC requires that all of its New Markets projects are eligible to receive historic tax credits. So then, once a CDE has identified a project and has allocation, they use that tax credit allocation to offer investors tax credits in exchange for a qualified equity investment, or QEI. If you recall, we had quite a few acronyms to go over. And we also discussed how to calculate the value of the new market tax credit. That a new market tax credit is taken over a 7-year compliance period, and that the investor receives 5% of the tax credit allocation over years 1 through 3, and then 6% of that tax credit allocation over years 4 through 7. And this results in it being a 39% credit. So CDEs take that QEI, they make it QUICkie to a Qualic B located in an LIC. It's really not that simple, but that's how we went through it. And as you can see, we sort of started defining the structure here of the new market tax credit process. But most importantly to Main Street, we discussed that HTC buildings must be commercial, or they must be a residential rental property. We also talked about the new market tax credit focus on commercial uses. And we highlighted some uses such as grocery stores or healthcare centers, potentially workforce development facilities. Whatever that community needs, that's what the new market tax credit is for. But new market tax credits can also include some residential components. However, there's an 80-20 test that must be met, and that means that the residential total gross revenue cannot be more than 80% of the total gross revenue of a building in a year. New market tax credits also have SIN businesses. We have those listed here. So if you're looking to build a golf course or a racetrack or a country club or have a suntan facility in your property, the new market tax credit is just not going to work for your business. So we did cover a lot during that first webinar and a lot of the mechanics at the top end. So now we want to really dig into some questions that are more important to the businesses, the landlords, the tenants, and again, Qualic B, qualified, active, low-income community businesses. So with that, I want to start with some of the most common questions that we received about tax credit financing. And that first one is, how can a tax-exempt entity or nonprofit capitalize on tax credits? And Amanda, would you like to start that discussion?
Yep, sure, no problem. So thank you very much for having me here. So I think Laura did a great job initially kind of going over, I'm assuming, what you guys talked about last time. She did a really good job of talking about the QREs. I do actually like Meryl's description of what is a QRE. That's a pretty good description of how to do it. It's not as easy as that, but the shaking of the building is a good starting spot to say what counts and what doesn't. We obviously dive really far into that. But we're going to talk about how a nonprofit can capitalize, like we said, on tax credits. For the historic tax credits, for a nonprofit, there is some hurdles that they have to kind of get over. The main thing is there's this tax-exempt use issues that are associated with historic tax credits. Basically, in Section 47 of the Internal Revenue Code, which is the code section that talks about historics, they provide that qualified rehabilitation expenditures are eligible for historic credits do not include expenditures allocable to the portion of the property which is deemed to be basically tax-exempt use property. And basically what that's kind of saying, and we're going to a little more detail, is that if you're an owner of a historic building, definitely what's going to probably be happening is you're going to be creating one or more new entities, because you being the tax-exempt entity cannot just directly own the building. Any portion that you own of that building, those credits would be a law. You wouldn't be able to take credits on whatever portion. So a tax-exempt owner would be a problem. Also, a tenant of a historic building could cause a loss of the credits if you're not careful. So there's a lot of careful structuring that goes into making sure that any kind of tax-exempt entities that are participating, we're structuring them the right way from the beginning. And another thing to kind of keep in mind, which the last bullet says, is that grants and donations that are being given to the owner also can cause tax problems. You can get them in, but you kind of have to handle them appropriately and funnel them probably through some other way. But just doing a grant or donation directly into that entity that's claiming the credits would be a reduction of the tax credits if you don't handle it the right way. So the next slide is, so the tax-exempt ownership. One thing is, like, what is a tax-exempt entity, or who is a tax-exempt entity, really? They list them there. It's basically any governmental or state entities, any organization obviously exempt from income taxes, such as a 501c3, a foreign person or entity, or a Indian tribal government. Now, it has a question there, can a tax-exempt entity or its sub-entity make a 168 election to be taxed as a for-profit entity? And it definitely can, and that's usually what is required. A lot of times you'll see that if a new entity is created that's going to own the historic building, you might even see another new entity gets created that the tax-exempt entity would own, but you don't want that entity to be treated, though, as a tax-exempt entity, so you have to make this 168H election, which is an election where you're taking an entity that's owned by a tax-exempt entity and saying you don't want this entity, though, to be treated as tax-exempt, and you want it to basically be a taxable corporation. So that's an election that you make, and that is usually how you can kind of get around or make the project still be eligible for historics and not have it be ineligible due to it being owned by a tax-exempt. And then the end user of it being the same tax exempt, there can be some hurdles with that as well. So we just have to kind of watch with those. On the next slide, it talks about tax exempt use. So we talked about maybe the end user being tax exempt could be a problem as well. So there are limitations on the tax exempt use by an end user or tenant. So there used to be a 35% limitation, now it's up to 50. So it's basically if the portion of the building, if 50% or more of the building is being leased to tax exempt entities, you have to watch this. Really what it deals with is this, it's called a disqualified lease to a tax exempt entity, and this is what would hurt the historics as well and cause a loss of credits. If you do have a disqualified lease. And there are some items they list down below there, which is what would constitute a disqualified lease. And it's, did the tax-exempt entity participate in the financing? Is there a fixed purchase price or an option to buy under the lease? Is the lease term in excess of 20 years? And has there been a sale or lease back with the tax-exempt entity? Usually in a deal with the attorneys, they're definitely making sure the leases satisfy all these items. They're making sure there's not a fixed purchase price or an option to buy and the sale lease back. They're definitely making sure the lease term is not in excess of 20 years. Any deals I'm closing, if there is a tax exempt entity, we're following all the right rules to make sure it doesn't count as a disqualified lease. And then the next two slides, we just thought we'd kind of go over. There's basically two scenarios when you're doing historic tax credits. There is a single tier structure, we kind of call it, and then there's a master tenant structure. So in the single tier one, which is the first one, I'll just kind of go through it. So there's the property owner in the middle, the really big box, which is Tax Credit LLC. They're the ones who own the historic building. They're going to substantially rehabilitate it, and they're the ones that are going to generate the QREs that we talked about. So they're the ones who own it. As you see right above on the left-hand side, there's like a managing member, developer affiliate that owns 1% of the entity, and it's usually, they're the ones, the developer that's putting in the equity, and they're getting 1% of the credits and losses and profits. On the right-hand side, you see the Tax Credit Investor LLC. They're the ones who, and the reason they own 99% is when you do the direct structure, because the Tax Credit LLC property owner is the one who gets the QREs, the way those credits are passed through in a direct structure is it's based on the ownership of that entity. And so you want your tax credit investor to have as much ownership as possible in that entity so they can get the majority of the QREs, which is the historic tax credits. So you want them to own 99% of your entity, because if the managing member owns 90 and they only own 10, then the managing member is the one getting 90% of the credits. That's how the credits flow. So they will, in turn, though, put in the historic tax credit equity that was talked about. So these investors will pay for those QREs. So they'll put the equity into the tax credit LLC entity, and then for that, they get 99% of the credits, and then the profits and losses and cash flow. So that's how that works. And then you've got your developer on the right-hand side getting the developer fee. And then in this tax credit LLC entity, they just own the property, so they're probably leasing it to the tenant. So then that's why you see on the bottom right the rental payments coming in from the tenant or tenants, plural. And then obviously you're going to have a construction or perm lender that is giving you loan proceeds, and you're making debt service payments. But it's a pretty simple structure, but that's what we would call the direct or the single tier structure. The next one, go ahead.
To interrupt, one question that came in is, why does the managing member entity hold on to 1%, and why does the investor not get all of the credits?
I can address that.
Go ahead.
Go ahead.
Yep, go ahead. Yeah.
Oh, I was going to say it sort of meshes with what I'll be talking about next, which is the reason why it's a 1% hold versus a 0.01% hold like in low-income housing is that there was a revenue procedure 2014-12, which effectively required that each member of the LLC or partner in the partnership have at least a 1% hold, a 1% interest of credits, profits, losses, and cash flow. Yes.
Okay, so then in the next one we're going to talk about, it's the master tenant structure. It's a pretty popular structure as well. So in this one, what happens is you have a landlord and a master tenant. So you'll see the landlord is on the left, landlord LLC. They are still the property owner in this case. They are going to own the property. They're going to do the substantial rehabilitation. But what they end up doing is, and they will have the managing member of that will own 90% of that entity. And I'm going to explain why in a minute. But the managing member will own a majority now of the landlord entity in the master tenant structure. And usually then you'll have like a 10% owner, which is the master tenant entity that you see to the right there, the master tenant LLC. That entity gets created solely to do this deal as well. And so they now own 10% of the landlord, along with the managing member owning 90. And what the landlord does is they rehabilitate the property, and then they pass through the historic tax credits to the master tenant. So there's something in the historic tax code that allows a landlord entity to pass through the historic tax credits to a master tenant. And so in this case, that's what they do. So then really what happens is the master tenant now, even though they didn't rehabilitate the property, they're the ones who receive the historic tax credits. And so it's the owners of the master tenant entity now that get to claim the credits. And it's the same thing as in the direct, as far as it's going to be based on ownership. So what happens in the master tenant structure is the tax credit investor LLC owns the majority of the master tenant now. So instead of owning the landlord, they now own 99% of the master tenant entity, which allows them to get 99% of the tax credits and the losses and cash flow and everything. And they will put their historic equity down into the master tenant now. And what happens is, since all the equity goes into the master tenant, or in that scenario, then what happens is the master tenant, through their 10% ownership, they push the money over to the landlord as partly equity because they own 10%. They can also pass it through as a lease payment. I've also seen the master tenants loan it over to the landlord as a really low rate, interest rate loan. But the money still gets from the master tenant over to the landlord so that the landlord can use that equity to build the property or to rehabilitate the property. And then in the landlord entity, you still have the construction perm lender that gets the loan proceeds and makes the debt service. But between the landlord and master tenant, there is rent being paid. And then the master tenant entity is who's really subleasing it out to the real end users. So as you see at the bottom, it's either subtenants or end users that they're collecting. So the master tenant is collecting rent from the subtenants and then turning around and paying rent over to the landlord, so that the landlord can service the debt. So it's a pretty easy structure. There's a few extra boxes and things, but the attorneys are all very good at making sure everything gets structured right accordingly in the beginning. But this is a pretty popular structure because then in the landlord entity, you don't have to have your investor inside that entity. It's over in the master tenant entity instead. So there's no other.
Oh,
go ahead.
I was going to say, does Dan or Rita, do you want to sort of expand on that from the attorney point of view, setting up the different entities?
Sure. So I think one of the key things in these new market historic deals, or historic only, or frankly new market only, is making sure that you sort of A, plan for the end in mind, and B, try and make sure that the structure is set as much as possible before you go out to the wider group. One thing that tends to happen here is that the Qualic B or the historic developer ends up paying the legal and accounting costs for everybody. So I think you're going to hear us harp on this a couple of times. It's sort of important to try and get your structure set, and pick your structure, if it's a single tier investment, which is historic only, typically, very rarely will a single tier simple structure be used for a historic new market deal, or a master lease structure, which is more typically used for a new market historic deal, or just historic only. I think the advantages of a master lease pass-through structure from a legal perspective, that it's easier to get all the deal participants to agree to it. In other words, the historic investor oftentimes cares a fair amount about being protected, that they don't get wiped out in case of foreclosure. In a single tier structure, you would need something called a foreclosure rights agreement from the bank, basically saying that they'll forbear from foreclosure for 5 years. That's very hard to get. On a master tenant structure, you can get something called an SNDA, a subordination non-disturbance agreement, which allows a lender to foreclose as long as they decide not to, or agree not to disturb that master lease, which, as Amanda mentioned, is how the tax credits get passed through pursuant to 50D of the code to that master tenant. So the other benefit of the master lease pass-through structure is that in a single tier structure, you have to reduce the basis of the asset by the amount of the historic credits. So if you have a short-term sale scenario, that can be negative. It's also, some people don't like to do it. It also means that the landlord, if you have your investor in that landlord, the investor gets 99% of the depreciation and losses. In a master tenant structure, you instead take that historic income or historic tax credits into income throughout the useful life of the property. So that changes if it's residential, commercial, but that spreads that out over time. And it also allows you to, if you're the sponsor, to get depreciation and losses at the landlord level, while the investor gets just a stream of cash flow at the tenant level. And you can better sort of decide how the cash flow goes, subject to the safe harbor. So those are really the legal advantages of the two structures. I'll note that if you're combining new markets and historic, almost 99% of the time, if not 100% of the time, you end up using the master lease pass-through structure, because you need a separate place to get the tax credits up, and a separate, it might all flow to the same place, but most of the CDEs do not want to be equity investors, and it becomes very difficult to leverage the historics in a single tier structure if impossible. So there's lots of reasons why the master lease pass-through structure tends to be used in new market historic deals. I'm going to go into some amount of detail regarding some of the challenges that the historic credit has faced. Maybe would now be a good time to do that?
Yes, please. What are some of the recent challenges that the HTC has faced?
So I put the challenges in three distinct buckets, two of which we have slides on, one of which I'll just tell you about because it's fairly simple. I'm going to go from old to new. So there was a court case now many years ago, sometime in 2012, I think, maybe before that, which was called Historic Boardwalk Hall, which basically threw into question whether or not historic investors were truly partners in partnership, in the partnership claiming the credits. What that did was throw the whole market into disarray. So what the IRS came out with at the end of 2013 was a revenue procedure that was formally issued in 14 called 2014-12. All that really did was try and put the market into some degree of less panic and also provide a safe harbor for structuring historic transactions. It doesn't address new markets. It doesn't address low-income housing tax credits. It is only a historic safe harbor. And what it effectively says is all of the craziness that came out from that historic Boardwalk Hall case regarding who was a partner and whether or not the partners were truly respected as partners in the partnership, you can ignore all that if you follow certain guidelines to the letter in your historic deals. So, effectively, I can go on for an hour about the 2014-12, but the main concern was whether or not partners were getting the benefit of their bargain and taking risk as well. So what it effectively does is it lays down certain guidelines, like the fact that each member has to have at least 1%, like that call rights are no longer allowed, but put rights are, like that the investor should get a commensurate and it must receive the reasonable anticipated value that is commensurate with their percentage of the deal. So what that effectively means in either structure is that they're supposed to get 99% of the cash flow, residual, and basically all the economic items. Now, you may ask yourself, well, hold on a second. What happens if I bring in an investor, and does that mean they get all of the cash flow for 5 years? Actually, no. There's definitely ways to moderate how the cash flow flows to that investor and make it so that the sponsor and the investor have some amount of certainty regarding the bargain that they struck. But it is important that if the transaction hits a home run, that the investor shares in that home run. If the transaction hits a speed bump, the investor gets hit with that same speed bump as well. So the things that have been changed because of that revenue procedure is that things like developer fees and incentive management fees are very closely looked at. Incentive management fees are basically no longer allowed. Developer fees are now restricted, and any outside fee and the master lease payment is usually looked at now by a independent third party, and something called a reasonableness opinion is obtained from either an accounting firm like Novogradac or a valuation firm, which basically goes through whether or not that development fee is reasonable. It also, like I said previously, it did away with the standard call right of fair market value to get the investor out. So now the investor can have a put right, but there is no call right. You might ask, well, what happens then on exit if the investor doesn't want to get out? What the IRS giveth with, or taketh away with one hand, it giveth with the other. It allowed something called a flip of interest after year 5. So effectively what happens in most historic deals is that at the end of the compliance period, the interest of the investor will change automatically or close to automatically, depending on the deal, down to something like a 5% interest. So they will be decreased from a 99% interest to a 5% interest. Sometimes it's slightly higher depending on the investor requirements. The managing member, which was at 1%, will commensurately increase by a similar amount that the investor decreases. So effectively what the revenue procedure did was it, in my mind, added a fair degree of certainty to the marketplace, which was good for pricing and good for overall deal structuring, but it did create sort of a box. In that box, the investor has to have downside risk and be committed to the deal at least 20% prior to placement in service. Certain guarantees are no longer allowed by the sponsor, which makes investors a little bit nervous and requires some amount of additional structuring and structuring discussions. The main impermissible guarantee is the 100% structure risk is now completely on the investor, which is why all investors require transactions to be safe harbor compliant, is that they want to make sure that they fall under the protection of the safe harbor, which lowers their risk on structure a fair amount. In general, though, I think Revenue Procedure 2014-12 is a positive in the long run because it provided certainty and allowed us to move forward with the deal structure. It is only difficult if you have some reason in particular you can't meet that safe harbor, then you have to find an investor who's willing to do a deal with you that doesn't meet it, which is a rarity. So I'm going to move on from the revenue procedure and talk a little bit about 50D income. 50D income is only in relation to the master tenant lease pass-through structure. That's that second structure chart that Amanda went through. And I'm going to somewhat short-circuit this because this is now the new guidance and there's no older deals that are really being affected by this at this point. And what it used to be is that if you had a master lease pass-through deal, the way you got out of that deal was that the unamortized historic income would be rushed to the front. It would flow to the investor. The investor would increase his capital account and therefore get when they exited, they get they'd increase their basis. When they exit, they get a corresponding capital loss in addition to that income. So it would basically be a wash. What the IRS said with the 50D guidance is you no longer get the corresponding capital loss. You can't increase your basis. So what does that mean? It means that now there is a 50D as a partner item, not a partnership item. So it does flow to the investor. It does not increase the capital account. They don't get to increase their basis. However, the investor does get to choose whether or not if they're going to take it over the life of the transaction or the life of the building, or they're going to take it all at once and accelerate the income in the year that they exit. So I would say most investors do not accelerate, and I think they are largely going to take it over time. But the real negative regarding 50D is that there are pricing considerations that have occurred because of it, with the corresponding capital loss and the negation of the tax hit. The value of the tax credits was obviously more. Now that there's income to be dealt with, and pricing has been reduced, and pricing has been reduced somewhere between, I would say, 8 and 10 cents from its height. Although, frankly, at this point, since 50D pricing has largely been built in, unless you're doing a deal and comparing it back to a deal 3 years ago, what you see is what you get. But it has reduced pricing, as well as the last thing I want to talk about that has reduced pricing as well. And that is the recent Tax Credit and Jobs Act, which changed the historic credit from a one-year credit. So that 20% credit that Amanda was talking about is no longer taken all in 1 year. Instead, it is taken 4% a year over 5 years. Nothing else really changed except that. So what does that mean? Well, just the time value of money for that investor. If the investor is not receiving its income, its tax credits on day one, but instead is receiving it as a stream over 5 years, the value of those tax credits to them has been lowered. There were fairly generous transition rules which kept the 1 year credit in place for certain deals. I think at this point, if you're doing a new deal, you do not meet those, or very rarely will you meet those unless you own the project and are regarded taxpayer prior to the end of 17. as you can imagine, unless you've been planning on your deal for a very long time, that's probably not the case. All that, again, the main impact of that is it reduced pricing, another 8 to 10 cents. So one thing I will say before we go and move forward, a lot of the stuff we're talking today is sort of high level, and we're talking about some very, very complicated subjects that, as each of your potential transactions or future potential transactions might have complexities that we're not addressing here for obvious reasons because of time. But Rita and I would be happy to make ourselves available as a resource. Our email addresses are at the end, and you can, if you have questions regarding particular unique features of your transactions, you can feel free to give us a shout out. And while we may not be able to help you in full, we can at least give you some basic guidance and hopefully put you on the right path. So I know that there were additional questions regarding how you pair multiple tax credits. Should we start that, Amanda, or would you like to take the lead?
You know what? If you, I can start, and then you guys can even, maybe you want to talk. I could do the typical leverage structure for new markets, and then if you guys want to talk about some of the twins, you can do the twins if you want.
That sounds perfect.
Okay, perfect. All right. So for new markets, we thought we'd do a couple structures. So Dan and those guys will do about the twin structure, but I thought I'd do a typical structure for new markets. The leverage structure, this is by far and large the most popular structure we see. There is a structure out there called like the unleveraged, but I see that maybe less than 1% of the time. So it's typically, this is the structure for new markets that you would see. So I know that I think on your last session, you guys went through some of these acronyms, but the way that it basically works is a CDE, which is the middle yellow box, which would be NTCIC, for example. Like we talked about, that's a subsidiary, actually, though, and the one in the middle. So the CDE that says Alicatee in blue on the left is really probably the NTCIC entity that applies. When they win an award, they set up subsidiary entities, and every subsidiary of theirs will close a different transaction. So the one in the bright yellow box in the middle that says CDE subsidiary, that's more of the NTCIC entity that has received new market allocation, an award, and they are going to do a transaction. And then in the top right-hand box, you see the tax credit investor in bright yellow, which that is usually a bank. It's a PNC, a U.S. bank, JP Morgan Chase, Wells, Capital One. Doesn't have to be a bank, but a lot of times we do see that it's a bank entity. They're the ones who are interested in buying the new market tax credits because, like I'm sure that you guys learned in the last session, it's a dollar for dollar reduction on their tax liability when they get to claim these credits. So they're the tax credit investor on the left. In a leverage structure, the way that it works is that you take sources, the project takes sources that it was otherwise going to use to do its deal. So, and we're going to kind of go over on another slide, what are some sources you could use? But you would take sources you already had lined up, like a loan from a bank, if you're doing capital campaigns, if you're a nonprofit and you're doing a capital campaign, different, maybe EB-5 money, definitely like soft loans from the city or the state, or things like that. But you take your other sources that you were going to use to do the deal, and you find a way to like leverage those. And the way you leverage them is through the top left box that says lender at the top. That is what we call our leverage lender in the deal. And depending on what your sources are will depend on what this entity actually is at the top. A lot of times it's some affiliate of the Qualig B that gets created, some new entity that can pull all those sources together. But the lender up at the top, what it does is you take your money that you were going to use otherwise, and you combine it with the tax credit investor money that the tax credit was willing to put in, the investor was willing to put in for the equity. And you pull that money together. So the box that's in the middle that's called investment fund, that is a newly formed entity that gets formed to do this transaction, and it's usually a single member LLC entity. And what it does is it takes the leveraged loan and it combines it with the tax credit investor equity. So as you see on the left, it's $70 for a loan, $30 of equity. So the investment fund together between those two items pulls together $100, and then the investment fund turns around and takes that $100 and makes a QEI, and I think they mentioned before it stands for Qualified Equity Investment, but they turn around and they take that $100 and they make a QEI into that CDE. Now, when the investment fund makes the QEI into the CDE, that is what generates the new market tax credits. That's the mechanism. So the minute that equity investment goes into the CDE designates it as a QEI. And when they do that, and there's a form they fill out, that signals that the investment fund entity can now start taking the credits, the new market credits. And because the investment fund entity is usually a single member LLC that's owned 100% by the tax credit investor, by doing that, then really that's how the tax credit investor gets 100% of the new markets, is through that mechanism. But what happens is through this webinar. Sorry, do you have a question? You didn't go to Couch. Oh, sorry. Okay, somebody must be talking, I think. So with the QEI, what was I going to say? Oh, so with that $100 though, so the reason that leverage structure works so well is because the QEI was $100. I think if you remember before, the credits that get earned off the $100 million or at the $100, the credits that get earned are 39%. So off of that 100 QEI, the investor gets $39 of credits. So they, based on the time value of money, they're not going to pay $1 for every credit because, like you guys talked about last time, the credit is earned over 7 years. The 39%, it's the 5 for the first 3 and 6 for the last 4. So because of the time value of money, they're not going to pay $1 a credit. So if they pay somewhere in the high 80s, that's where you get that they're willing to put $30 of equity in to get $39 of credit. That's a good scenario for them, and usually that's all the investors are in it for, is the credits in a new market deal. I know with historics, when we talk about the twin, there's other items that the investor usually wants to see besides the credits. But in a new market structure, the investor usually just cares about the credits because on their internal rate of return, putting in $30 of equity and getting $39 credit is a pretty good return for them. So, but that's how that's generated. And so then the CDE entity has the $100 QEI, and then they turn around and they make that QLICI that was talked about last time, which stands for Qualified Low Income Community Investment. And it's usually in the form of a loan, but they turn around and they take that $100 and they have to disperse over 85% of it at least. And usually it's in the high 90s. But the CDE then turns around and takes that $100 and disperses most of it down as loans to these businesses. So to the Qualic B that's down below, they will turn around and give loans to them. So that's kind of how the new market structure on its own, without historics being blended in, which is the next structure. But on a typical just leverage new market structure, that's how that kind of works. Dan, did you want to talk about the twin structure?
Sure. This is Rita. I'll take over on
hi.
Yes, Amanda. Hello. So I'm turning to page 29, the twin leverage structure. This shows how the new market structure that Amanda just outlined can be modified to address the use of both new markets and historic in a transaction. And there is a lot of complexity here. You'll see there are additional boxes and arrows. And this is what I would call the most conventional side-by-side approach. But there is wide variation in the industry. And it's really useful to get a sense of what your potential investors' preferences are and what their counsel's preferences are. In that way, having experienced counsel on your side to represent the developer could be really useful because they can give you a heads up about what the structuring might look like as you go forward and the pros and cons to you as you consider a transaction. There are iterations of this type of structure that are slightly more complicated, but that yield some different benefits. So this transaction, as you'll see, it yields both new market tax credit to the tax credit investor and also yields historic tax credits to the tax credit investor. And those are, as I said, a side-by-side approach. You can structure things slightly differently to generate new market tax credits off of the historic tax credit equity as well, which we've not attempted to do here. But that would yield then additional benefit to the project in using the same equity investments to generate both new markets and historics. Here, they're generated separately. So just to walk through, it's the same structure that Amanda just outlined, where you have a leverage loan coming in at the top of the structure and equity coming in for the new markets to the investment fund making the investment down at the CDE making the loan down to the Qualic B. But the Qualic B is then getting a secondary set of capital in the transaction through the master lease structure with the master tenant, where the Qualic B is passing historic tax credits off to the master tenant and in return receiving historic tax credit equity. In this structure, just similarly to the master tenant structure that Dan and Amanda talked about earlier, the sponsor can have control over the development of the project at the Qualic B and the master tenant by having a managing member affiliated with the sponsor that is participating both in the Qualic B and at the master tenant level. And here we see that managing member has a 1% interest at the master tenant, and the investor has the 99% interest, so that the new market tax credit, the historic tax credit equity can flow to the extent of 99% up to the tax credit investor. It's a very similar structure to the leverage structure that Amanda started with on the prior page. But there can be quite a bit of complexity here, as Amanda was talking about. For new markets, the analysis of the investor's return is somewhat simpler. With historics now, investors are looking at a variety of other different accounting considerations, and those become very important in pricing and in structuring. So it's useful to have a solid team of accounting and legal counsel to help you figure out all of those components as you're going to the market to choose your investor, to choose your CDEs and the parties that you're working with, and also to save costs, to do a lot of pre-vetting and really narrow down the possibilities and have things set in stone that we know will be palatable, acceptable to the industry, to the marketplace in advance, so you're not wasting time or spinning wheels in pursuing a structure that's not going to be accepted.
I'll add one other thing to that. I think it is important it's important to go with people on the investor and the CD side that understand the combination of new markets and historic. Because there's definitely CDs out there and some investors who have never done a joint deal before, and those are especially painful. Obviously, NTCIC knows them and does them all the time, but there's other folks that don't. And that may be a good transition to how do smaller projects monetize tax credits.
That's true. Thank you, Dan, because I want to talk about NTCIC's Urban Henderson Main Street Revitalization Fund and how we've worked to try and simplify these twin deals as much as we possibly can, because as we've heard, there's a lot of complexity in setting this up, and so having a good team is vitally important. And what we've done with this fund is that we will invest in both the new market tax credits and the HTCs. A project who comes to us cannot elect to take one or the other. This is sort of a product that we've put together, and we are working with our partners on the investor side who have agreed to this structure. And also we have good relationships with legal professionals and accounting professionals who we've tried to work to simplify the structure and use the HTCs within the new markets. Rita alluded to a different type of structure that is similar to the one that is used with the Main Street Revitalization Fund. And we do all this because we want to minimize the legal fees and transactions for these smaller deals. Because this, while this may be a big deal for Main Streeters, because as we'll see, some of the total development costs are at least $5 million or between $5 and $8 million, this is still kind of leads us into how do we know if a tax project is big enough to use tax credits? Because, as we said, sometimes, you know, it's not, the juice isn't worth the squeeze, as we'll sort of get into. So I would like us to start talking about, maybe Amanda, you can sort of talk to this about project size when we start really looking at QREs and versus the tax credits that are received. Why is it that smaller projects find it harder to use tax credits?
Sure, no problem. So yeah, like Laura was talking about, project size really does matter in both historics and new markets. You know, in both of those scenarios, it kind of starts with your development costs, obviously your total development costs. In the historic world, it's not your total development cost as much as it's your QRE as well. So what is the size of your QREs that you're going to be delivering to the investor? You know, when your QREs are really, really low, there just starts to not be a benefit that's going to be a lot benefit for some of the headaches that get involved with it. So, you know, you just want to have a big enough QRE size. A lot of times, and I think it says here functionally related, a lot of times if you have one building and that building just doesn't have that much of a budget or that much of QREs, you know, you may want to group another building in if it's feasible, especially if it's right next to it and it can kind of still be one project, because you kind of need to look at the size of it and see. The same thing goes with new market allocation. You know, you need a CDE to give you the allocation. Now, the good thing is with new markets, there is no such thing as a QREs. Basically, in new markets, as long as it's a cost of the project, it qualifies. So there is no QRE where there's good costs and bad costs. It's mainly just got to be cost for the project. But your development costs in a new market deal is hopefully the allocation size that you're trying to go after for the most part. But once again, if the size of your new market allocation is not high enough or your budget isn't high enough, it just starts to become really not maybe beneficial to you. I mean, and I know, I'm sure NTC with this fund is taking a lot of that burdensome away, but still in a deal, when you do it, there's a ton of agreements, there's attorneys, accountants, I mean, and they're all needed in the deal, but I mean, all the transaction costs at the end of the day have to get paid, and so it just becomes, a lot of times, we at Novogradac, we run net benefit schedules for the qualic Bs to kind of show them, like, here, net at the end of the day, after you pay the transaction costs and you pay any CDE fees if there are any, and everything else, net at the end of the day. And with historics, there's usually cash-on-cash returns that investors are looking for, like cash flow. So, and there's probably a priority return. And so with each one of these, we will layer in all the costs of doing this deal, basically, and kind of show you net at the end of the day, you got the equity in, but here's all the costs and what was your real net benefit. We do that a lot just so the qualic Bs know what they're doing, as far as like you're doing this because you actually have a gap and you need it filled, but you want there to be some benefit. That's the other item on there, the financing gap. So definitely in the new market world, there needs to be a financing gap in your project. You know, CDEs have to kind of satisfy this, like, we call it a but-for test, but where CDEs are really going to analyze your project to make sure that you need this subsidy. You know, kind of that, you know, would you be able to still do this project if you didn't get this new market money? So there has to be a real financing gap and a real need there. So, you know, you want to be able to support that and show that you need that money, and hence why you would be willing to kind of go through some of this, because, you know, it is a little bit more burdensome than just doing a regular non-tax credit deal. But in the end, it's worth it because people have a lot of times you have a financing gap that you just can't get filled, and this is a beautiful way to fill it. So these are just some of the things you need to really think about in the project size. And I will definitely say it at Novogradac as well. We do help with all that kind of stuff. I know I help it all the time with qualic Bs, looking at your budget, making sure this works, looking at what sources you have. Can we leverage them? You know, there's like Rita was talking about, and Dan and Laura, you know, you need a good team around you that can kind of vet a lot of these issues to begin with, so that before you even start to kind of close a deal or talk to CDEs or do things, you've kind of vetted through some of the initial hurdles to make sure we think that this really even looks viable to begin with.
That's right. Thank you, Amanda. I want to also have all the main streets out there sort of think, when they're thinking project size, this could be a very large project for a smaller downtown. And so there are downtowns that might have larger buildings, such as an old armory or a department store that is no longer in use. But some downtowns just have these smaller storefronts. And so, Amanda, can you use multiple buildings in a project to qualify them that might sort of increase these development costs for these smaller downtown, total development costs for these smaller downtowns?
Yeah, yes, you can. You would have to watch if you're doing a mixed-use project for new markets. I'm thinking if you're doing a mixed-use project, that whole 80-20 test that we talked about, where if you have residential and you have a commercial component, you've got to have 20% of your revenue coming from commercial. That test that we talked about, or was briefly talked about, but if you have a mixed-use project and you have multiple buildings, technically that test has to be passed on a building-by-building basis. So if you would have one project that didn't have commercial in it, you could run into a problem that there is this integrated unit test that you could maybe fall under. It's a private letter ruling. So once again, just people might not know, but a private letter ruling, in order to really rely on that, unless you want to go get your own private letter ruling from the IRS, in order to rely on one that's already been issued, you'd really have to meet the same facts and circumstances to feel comfortable with it. But there was a private letter ruling where if you have multiple buildings, could you treat them in all respects as one building? And it would have to be, I'm trying to think of some of the things, but it's all the accounting, all the activities are being treated as one. I think it's something about all the common areas. So you'd have to look at the private letter ruling for the integrated unit test to make sure, but otherwise you just have to make sure every building on its own could pass that 80-20 test. But that's only if you have a mixed use. But otherwise you can pull multiple buildings together to get the project size up.
Okay, I know we've just hit the 2 p.m. mark, so I wanted to just sort of skip ahead and sort of finalize this because we were sort of, we'll skip through the community benefits. Oops. And sort of what are the biggest items I need to have in place in order to close a project? And we've sort of been hitting on those. So I'm going to start with finding your dream team. You need professionals to start looking at projects from the very beginning, such as an accounting or legal professional, or also your historic preservation architects or general contractors that have worked in historic preservation before. You don't want anybody learning on the job for this. So we feel that's very important to really build your team early on. Also, you want to be through your NPS process, at least know that your buildings are certified. Historic buildings are part of a certified historic project. And do we have any additional questions, or do you have any comments about project readiness from the accounting and legal perspective?
I think that's what you've outlined is correct, and I would say, in particular, also making sure that you're working with experienced investors, CDEs such as NTCIC, accountants and attorneys will get you to a closing more efficiently and more inexpensively. As you said, working with experienced people will cut down on mistakes, errors, or just delays because of the inexperience.
It also helps in the following way. You have to be careful about starting your transaction too soon and going forward with a wider group and having. There's too many conference calls in this field, and unfortunately, the Qualic B, the sponsor, pays for all of the costs. So really, you want to run what I call a tight closing. And I think most of the participants who have done this before will do that. I know that lots of the CDEs, especially ones like NTCIC, I think the goal is to make the Qualic B pay as little as possible to make sure that the subsidy that they're getting is maximized. The only way that happens is if you identify your structure early, you make sure that you fit the structure to the deal, You know, some deals don't fit every structure. A small deal can't have, 2,000 boxes in the structure chart and not suffer some degree of inefficiencies. All the time, someone on my smaller deals, someone will come to me and say, hey, I'm doing a new market historic project. I want to include solar too, and I want to do a biomass thing next to it and all this other stuff. At some point, somebody said it earlier, this is my favorite phrase, you have to make sure that the juice is worth the squeeze. And you want to make sure you understand what the true net is for the project. The true net is not the 39% new markets or the 20% historic or even the state credit. Those are great subsidies. You can layer subsidy upon subsidy upon subsidy, but the net is what the benefit is to the project at the end of the game. That includes exit costs, that includes legal, that includes accounting, that includes all fees. So I think when I have a new client, especially smaller nonprofits or smaller Main Street folks, what I say to them is don't get lost in the subsidy. Make sure you understand the net and make sure you have an efficient and logical closing. Now, I think the whole purpose of the NTCIC product that they mentioned earlier was to try and cut down on some of those transaction costs, I think in a logical way. And for the record, I don't represent NTCIC, so I have no reason to say that except that I think every good CDE out there and every good investor out there, this should be one of their biggest concerns because new markets, and to some small degree historic, have too many transaction costs. And I think if you're a sponsor or if you're a developer, if you're a Main Street organization, you want to make sure that once the project gets going, it not only just starts, but it gets to closing and it gets to completion and you have a successful unwind 5 years or 7 years later, depending on if it's a historic or historic new markets. So I think that's what I would focus on, and that tends to be some of the hardest challenges in addition to the construction, in addition to all the things that you think about when you do any type of historic rehab project.
Wonderful. Thank you, everybody. I know we're a little past time, and we received a lot of great questions that we may not have been able to cover during the audio portion of our webinar, but we will be discussing them in our follow-up when we post the audio and download of the webinar itself, including questions like is there any issue of tax credit investor being the managing member and the developer, nonprofit entities use of grants or for-profit entities use of grants, or if there are any tenant issues that may cause tax issues, as well as several others. So first of all, I want to thank Dan Kolodner, Rita Schwantes, Amanda Reed, and Laura Burns for their time today. Thank you to everybody who joined us this afternoon. And as a reminder, our next and third and final webinar will be a week from today, which is April 18th, again at 1 p.m. Be sure to follow us on our socials. We'll be posting detailed information about our final webinar. And we're also finishing up our online survey for community impacts. So be sure to, if you have time, fill that out as well. And if you have any follow-up questions, feel free to reach out directly to any of our panelists this afternoon. And we look forward to speaking with you next week. Thank you, everybody.